Hello, everybody. It's Tom Sheridan from 7IM and Chris Darbyshire. Chris, as you know, the Chief Investment Officer. Welcome to 2015. Here we go again, Chris. 2014, quick recap, first of all. From a performance standpoint, we did pretty much what we thought, but not necessarily the way we thought.
Indeed, not at all how we thought. We got there in the end, but we really put our faith in equities last year, not in government bonds, and didn't quite work out, as you said, the way we planned. Government bonds did very well during the year, much to our surprise, but actually so did equities. So unfortunately, our equity decisions were good enough that they carried us over the line from a performance point of view. But I think the thinking behind it was interesting. You know, we believe in equities because we think the world is still recovering from a very bad event during the credit crunch. But we do think it's recovering, and we do think economic growth is coming, albeit slowly.
But it's certainly not a straight line. There's all sorts of things that can happen as we move into 2015. One of the things that we did, as you mentioned, was didn't like fixed income, went very, very short-term fixed income. That positioning is not a million miles away from where we are right now, a year later.
Kept that positioning pretty much all year. In fact, we've gone more that way as the year has gone on. We still think the fundamentals for fixed income aren't particularly good. And really, we think the buyers last year were big central banks. They were commercial banks that are under regulatory pressure to own bonds. We don't think the buying was based on fundamentals, per se.
Well, there's been a couple of big things that have happened, but before we get to those, there were a couple of pitfalls that you managed to sidestep along the way. So it's not only what we did with equities and what we didn't do with fixed interest. It's also, how about the alternative asset classes and what didn't happen to our portfolios that might have happened?
That's a good point. So we didn't really do a lot with alternatives last year. We had some small positions in sort of classic hedge fundy type strategies, but we had quite a big position in private equity, which actually performed rather well during December and actually, I think, cleaned its face for the year. The classic alternatives, the hedge funds, really had another very poor year. Commodities had another very poor year.
That was really the standout negative in 2014. And to your credit, during the course of the year, you not only avoided commodities themselves, but you also took our emerging market position from the exporters to the importers.
That's right.
In retrospect, that one looked pretty good.
Looked very good in retrospect. We didn't think it would look that good. But when the oil price began to decline, we switched from sort of generic emerging markets into more Asia-Pacific emerging markets, which are importers of oil, not exporters. We got rid of our frontier markets exposure completely, and that turned out to be a very prescient move.
Indeed.
Yeah, and then we trimmed our high yield exposure and our emerging market dollar bond exposure, where there's a lot of issuance by oil exporters.
So you mentioned the dollar there. Certainly currencies played an important factor in what happened in 2014 in the 7IM portfolios. Quick word on during the course of the year leading up to where we are now in currencies.
So really two key decisions during the year on currencies. Number one was to run with the US dollar unhedged in the portfolios. Hurt us for the first 6 months, but came through then very strong indeed in the second half of the year. And the second key decision was to move into Asia-Pac equities, where you've got more resistance to the US dollar. And actually you have a lot of US dollar-based economies there. So Hong Kong, China, these are economies that are really closely linked to the dollar. So that gave us then more US dollar exposure in the portfolios.
So the move from emerging market importers of commodities also gave us the dollar exposure. Turned out to be a good decision on several counts.
That's correct. And it's very nice when you've got a tactical decision that sits well on two bases, on a currency basis and just because you like the asset and you think the returns are going to be good.
Chris, I know one of the most important things in your mind is the development of the U.S. economy, and can it actually lead the rest of the world by having consumer demand boosted perhaps by the oil price And it was you who told me about 9 months ago that shale was a game changer. And didn't that turn out to be prescient? Mm-hmm. Tell me what your thoughts are now on the U.S. economy.
Well, the U.S. economy was the great hope for 2014, but then got off to a rocky start with the very bad storms, the winter storms. So by June, really, the hopes for GDP growth, for economic growth in the U.S. had been dashed. I think this year we're now back to where we were at the beginning of last year. The U.S. is a great hope for the world, but you've got the cheaper gas prices in the US now is a much more significant force that we didn't have last year. And of course, the US economy is that much stronger. Employment is that much higher. And we're beginning to see signs of wage growth, which is another key missing piece.
Right. So still bullish on the US, bullish enough to pull the rest of the world?
Yes, I think the time is coming when the US has a material impact on the rest of the world. And of course, the biggest beneficiary will be emerging markets when that happens.
Chris, sometimes things are conspicuous by their absence. We haven't really talked about Russia very much, and they certainly have grabbed a lot of the headlines in the world over 2014, going into 2015. Do you care? Well,
I think we care from the geopolitical point of view. Here you've got a country that went very much on the offensive in 2014, partly to hide, I think, economic problems that were occurring at home. Now those economic problems have intensified.
Yep.
And so you do have this risk that Russia does something irrational. However, I think the other side of the coin is important here. As the economy gets tougher and Russians get poorer, actually I think it forces them back into rational behaviour mode even more. So I can see both. I think there's a small chance of an irrational act, but a bigger and increasing chance that they begin to come back into the international fold and start to do the right things for their economy.
So, ironically, the oil price turns out to be the friend of the West.
Indeed, yeah.
Right. So one of the important features of 7IM during last year was the yen and the Japanese equity markets. Quick recap on what happened there, again leading up to where we are now.
Yes, so again, we started the year with quite a lot of exposure to Japan, and it was a rocky ride for the first few months. Then it came good really in the second half of the year. We ran completely unhedged on the yen until about the third quarter. Then we tactically hedged the yen before the flash crash of October. So that helped us out a little bit on the downside. And just recently, actually, we've unhedged the yen again. So when Japan had that very strong rally in November, up 10%, I think, in 2-3 days.
Yep.
We then took some of that risk off the table, so we're back down to 6% imbalanced now in Japanese equities from 9%. And we've now unhedged the yen again. So we're sort of running at a pretty low level of risk in Japan at the moment. Still like it, but we're worried about a pullback.
So it's quite interesting for me to watch you operate. In adding equities, you add risk to the portfolios, but by managing the currency, you can actually reduce some of the risks that you've taken, which is very important in the environment that we find ourselves in right now. I think what we might do, if you don't mind my using a little aid here, I took a look at our portfolio snapshots as we're talking. They tell a very important story for me. They tell a very clear story on positioning. And if you look at our equity content in a balanced portfolio, we're at about 55% in equities. And within that 55%, we have a very strong Asian focus. We have about 22 of the 55 between Asia, emerging markets, and Japan. We're a little bit underweight in the UK, and we got about 8% in the US and about 9% in Europe. Give me a recap of what your thinking is with such a strong Asian presence in the portfolios.
Well, during the year, we really decided we wanted to get China exposure. There's a lot of fear around China. China has problems, but we felt that the economy was slowing in a good way. We felt that the government was showing its alert to the problems, and it's the government's management of the economy in China that's really important, not the concept of free markets.
Yep.
And how the market will behave. So we became positive on China. We wanted to get our exposure more towards China, but we didn't want to buy China A shares, unfortunately in retrospect, because they're now up 50% year to date. But the liquidity isn't really there for funds like ours.
Yeah, and that's very, very important to 7IM. We have to have that liquidity for us to keep our promise to you.
Indeed. So we went with an Asia Pacific mix of stock markets, which was had a decent amount of China in, but wasn't pure China, and that worked out very well indeed. We tried to reduce the Australia exposure within it, which we did successfully as well.
Which was part of the theme of getting away from the exporters, and again,
That's
that was
right.
part of the one that worked very well. Yeah. The fixed income portion of the portfolios tells an equally interesting story. Our gilt positions right now is almost nil. We got 1 or 2%, all short-term. We have about 5% in sterling short-term corp. Global corporates, we've got about 6%. High yield, we got about 5%. Emerging markets, which is a story that you have, about 6%. Global linkers, about 2%. So spread, no big real positions in fixed income, and 12% in cash. That, to me, is a very, very strong statement. A lot of very short-term maturities, almost nothing in gilts, which is a very extreme call for a business like ours. A good chunk of cash in a balanced portfolio. What are you thinking?
Well, the fixed income call this time last year was an easy one to make, but didn't go well. This year, it's an easier one to make, and I think it will go well. So the valuations are now significantly higher in the fixed income world, particularly government bonds, than they were a year ago. If we didn't like it then, based on fundamentals, then we really don't like it now based on fundamentals.
So the things that could go wrong, so we manage to our downside, are we do wind up with a deflationary environment, and that could send us into another good year for fixed income that we might not participate in. Or you may find that equity markets get rattled by something, and maybe one of those unknown unknowns that my fellow Americans talk about.
And they will get rattled at some point during the year. These things happen. But I think it's important for investors to focus on the trajectory of economic growth in the world, which is positive, and getting more positive, we think, as the oil price drops. So what you'll see as the oil price has dropped is people worrying about deflation, because it will feed through into headline inflation figures.
Yes.
And so the deflation argument will rear its ugly head for a while. But then we think the true economic dynamics assert themselves, which is you put money in people's pockets, and a lot of those people are going to spend that money, and you get a sort of consumption boost to the global economy.
So the lower oil price is effectively a tax cut in economic terms.
We think it's about $800 per, car driving American, and that is a significant amount of money.
That is indeed. So oil, a very, very significant event for lots of portions of the portfolio, not only on the benefit or the economic boost that it'll provide, but also on what countries and what companies to try to avoid feeling the negative impact of the lower oil price. Oil in general, though, if you read the headlines in the newspapers, which we studiously avoid doing, could be seen as something horrible. Whereas you have to think that over the long term, if you go back to only 10 years ago, the price of oil was not as high as it is now.
Indeed. And if you think what central banks have been trying to do, they've been trying to put money into people's pockets. They haven't quite managed it, and the tools they have are not directly addressing that problem. But that is what they've been trying to do, and the cut in the oil price really plugs that hole in the economic picture. So we think it's very positive indeed, although we think there will be deflation first, but then there will be reflation.
So the 7IM view, oil is a strong positive. It won't be a straight line, but it will eventually come through, and that is why we have our strong equity position. That is equally why we have our weak fixed income position. Since we don't have many alternative investments, currencies become very important. Tell us what our currency positioning is and why and how it works as a risk mitigator in the portfolios with lots of equities.
So our current position is to be fully unhedged on the US dollar.
So in a balanced portfolio, how big is that?
So that's about 20% of the assets in our balanced portfolios have dollar exposure.
Okay.
And the dollar is a safe haven currency. We also think it's on a strengthening trend, although there will be, pullbacks within that trend. And at the same time, it's really important that we think about sterling in relation to the dollar. And sterling is probably mildly weak as we go into the election and the uncertainty that that creates.
Now, Asian currencies make up about 10% of our portfolios. What's the thought on the Asian currencies?
So most of the Asian currencies we have exposure to are dollar proxies. Hong Kong, Singapore, and most importantly, China, whose currency is effectively linked to the dollar.
So it all adds up to a very strong position in the dollar, almost as strong as we have on the equity front.
And our thinking there partly is that without any long-term government bonds in the portfolio, without that anchor, because we're more worried about the anchor turning into a drag, then the currency management becomes particularly important, and as a means of reducing risk, it's very, very useful.
Something that's very topical right now we need to talk about is Europe. The Greek elections coming up on the 25th of January, I believe it is. And here we go again. Are we in Europe crisis number 2? The European governments find themselves almost in mission impossible. If they're being asked to write off the debt for Greece, then why wouldn't they do it for a whole range of other countries? So they can't afford to do it. Are we heading for the train wreck which has been postponed, or are they somehow going to muddle their way out of it again?
Well, I think, if they muddled their way through the last problem, they can probably muddle their way through this one. But I'm still a bit concerned. We would like to have, I think, more exposure to Europe. It's the one major developed market that, really has good upside in terms of earnings growth, and is also at a very reasonable valuation. And we think sentiment is playing a role. I'm surprised, frankly, that with the Greek election coming, that Europe isn't actually off a bit more. So we've been keeping our powder dry on Europe in anticipation of the market going down prior to the election. And then we think there is an opportunity because we think the election will not result in a train wreck.
Right. So you think that the potential new government, if it is surplus, won't take such an extreme position when push comes to shove?
We think that on the currency they won't, and this is really important. It's the risk, the real European risk is breakup of the currency. Provided the Greek government does things like, drive a very hard bargain over debt, that we think is a difficult and be a very noisy environment to be investing in, but we don't think that's a significantly damaging environment for economically.
We've had another good year. It's been a very difficult year in which to earn money for your clients while still taking the amount of risks that we promised to take. 2015 looks like it could be another bumpy ride, but we are hopeful that we can get you there again, and our views are quite clear. We have a very strong position in equities. We have a strong position in the dollar. We have very weak positions in the fixed income and the alternative asset classes. And those themes will continue until we appear here again.
Indeed.
Chris, thanks very much.
Sure. Thank you.
Happy New Year.
Happy New Year.